Welcome back to the home front. I'm your host, Reed Galen. Today, I am once again joined by Ron Insana. You all probably remember Ron, not only from his previous appearances here, but as a longtime contributor on CNBC and MSNBC and all things economic and business. Ron, welcome back. All right. Well, look, as I told you, and we'll pull the curtain back. I have lights directly overhead, but you and I share a similar affliction, which is if I don't wear the hat, the lights shine off my bald head and then I am distracted. So, look, Dodgers, Blue Jays. I guess I'm rooting for the Blue Jays. I was really rooting for the Mariners because they've never been to the World Series, and I got a lot of friends in Seattle. But you know what? It's the last for Clayton Kershaw. It's always great to see somebody like Shohei Ohtani, play at that level. And of course, it's been a long time since the Blue Jays were in the World Series, so I think it should be fun. Starts tomorrow night as we're recording this. So.
Yes, it does. I would have loved to have seen the Yankees win one for the first time in I don't know whatever it is, 16 years too, but. Whatever.
You know what? I don't feel bad at all about that. I don't feel bad about the Yankees not being in it one bit. Not one bit. If it was the Yankees and the Dodgers, I would be wearing Dodger blue from head to toe.
Yeah, you, my brother, my sister. Yeah, I know.
But all right. So you're a Bills fan for football, as we were talking about, but a Yankees fan for baseball. Now I know obviously Buffalo doesn't have a major league team, but
correct.
How did you get all the way across how'd you get all the way across the state? Why not like Philadelphia or Pittsburgh?
Yeah, never. Oh, a couple of reasons. Actually, when my dad was alive, going back in the 1960s, he was a huge fan of Italian athletes. So even when we were living in Buffalo, when the Buffalo Bills traded Darryl LaMonica to the Oakland Raiders in 66, 67, my father threw a fit and we ended up following the Raiders for quite a long time, even though we were living in Buffalo and kind of followed the Bills. And as a Yankees fan, as a young man with, everybody from Yogi Berra to DiMaggio, he was just
Mickey.
He was stuck on the Yankees. Mickey. Yeah. I mean, so that was part of it. I lived in LA for a long time, so I was a Dodger fan. I was there at the Kirk Gibson game.
I remember watching on television. Sure.
We were there at the stadium. It was phenomenal. And, sadly he suffering from the same affliction that took my dad, which is Parkinson's. And he's fighting a good fight, but it's a tough one. And he was a great athlete. And look, I have an affinity for the Dodgers. I've been a Yankees fan since I was a little kid, whether I lived on this coast or that coast. So
we'll get to the business at hand, but I will tell you this. So my dad was born in Brooklyn and my grandfather was a Brooklyn Dodgers fan. But when they moved to LA, he never watched baseball again. Like wow. he would take my dad and his brother to Yankees games because it was close enough, but never was a baseball fan again. I also heard a lot of people that when the Baltimore Colts left town in the middle of the night, they never had another team, even when the Ravens went back.
Yeah, Cleveland Browns too, right? I mean, it was the original Browns split. Right. And this moving the team thing has always bothered me. And, when Ralph Wilson sadly passed away, I guess now 11 years ago, and the Bills were up for sale and Donald Trump was looking at buying him for, a song, $900 million. But Bon Jovi was in the mix and wanted to move him to Toronto. And I can't tell you like how many people, those of us who are from Buffalo, the late Tim Russert included, sure. We were calling everybody we could to ensure that Bon Jovi didn't get the team.
Right. Because we are not crossing Niagara Falls to watch them play. We are not.
No, it would not be our team anymore.
No. So, Ron, here we are. Things are topsy-turvy, as always. We don't have, as you and I were talking about when we were talking about other things last week, there's never just one day. We don't get one day off from the insanity. So we can start wherever you'd like. Gold has taken a nosedive. AI seems to be a bubble, but also the passing the money around the poker table. $40 billion to Argentina. Where do you want to start? Dealer's choice.
We'll start with gold because I don't think it was that big of a deal in terms of the sell-off. I think, you have these shakeouts, particularly when you've been in a roaring bull market. Gold is still, I think, one of the best, if not the best performing asset of the year so far. Gold and silver have been just ripping to the upside amid concerns about sticky inflation, geopolitical unrest, political risk, tariffs, and the impact on inflation. And so we've had a huge run up in the price of gold. So you had to expect at some point, the ball was going to drop a bit and you're going to see something of a pretty mean correction. It was down 5% in a day. In the stock market, we'd call that a mini crash. And I guess that's kind of what you had in gold. But look, it's still owned not just by a lot of individuals, but central banks around the world have been hoarding gold now for several years. And it is the second biggest reserve asset in the world. So, I think it might have been just a blip. I don't know how much higher it goes from here. I think that's dependent on a lot of factors. But I never get too balled up about one day's performance, particularly when something like that has been up even way more than the stock market so far this year.
May I ask a question about the practicality of gold?
Sure.
I assume it's still being mined.
Yeah.
As it's being mined, do the markets price that in, that there is more gold being found as opposed to it just sitting in Fort Knox?
Yeah. I mean, we think it is.
Right.
No one's done that Fort Knox audit, have they?
No. Goldfinger left a long time ago. His name is now Trump.
I think that the mining of it is not so prodigious that you're going to worry about supply overwhelming demand at this point. I still think that something, and this is a rough estimate still, half the gold in existence is underground and half the gold in existence is above ground. So you get some incremental increases in supply. It's not like oil, where you can get these big gluts that take place and the price swoons. It's just not like that at the moment. So if there were to be some, huge, not just discovery, but some huge effort to lift all the remaining gold, out from underneath the rocks, as it were, you might see some impact on price. But it's being bought up for a reason. People are very nervous about the geopolitical environment, broadly speaking, not just here at home, but all around the world.
One more question, and this is about the practicality of assets, because you mentioned oil, but you can use oil for something, right? You can turn it into anything from a gallon of gasoline to a pair of Lululemon workout pants. Gold might be nice to look at. I assume it's convertible into other things, but is cryptocurrency sort of taking that on too, which is, you can't eat gold, you can't eat a blockchain code either?
Yeah. So Bitcoin in particular is referred to as digital gold. I still don't necessarily understand the use case for something like Bitcoin, which, in many ways is not viable for transactions at, $108,000 per coin, unless you're doing it, fractionalized in some way. And again, in a weird way, it exists in the ether. It doesn't really exist in the real world. Whereas gold does, and historically it has been used, in as some form of money for thousands of years. So it kind of retains. I'm going to just pull my shades down here while I chat with you, because the sun, as the seasons change, the position in my window also changes. Sorry about that. Okay. But gold has such a long tradition of being used as money, and is, a viable form of foreign exchange, if you will. And the late Art Cashin was on the floor of the New York Stock Exchange, somebody that I've known for decades, and I talked to nearly every day for 30 years. Said, always keep enough gold to bribe the border guards. And so there is a measure of security in having some gold or silver in your pocket just in case.
Right. Okay. So let's talk about, let's shift from gold and oil and crypto to AI and what it is doing. It seems to be creating almost an economic singularity here, Ron, which is it is hoovering up a massive amount of investment, but right alongside that, it is also hoovering up a hell of a lot of electricity, which is driving up electricity rates. So give us a sense. And then there's been a number of pieces I've read. My friend Grace Blakely wrote a piece about this sort of circularity of the AI economy, how NVIDIA is giving money here, it's going there, it's going, and it's coming back. So give us a sense of how, AI is affecting us and what we, the lay people listening to the home front, need to know about.
Well, a lot of things, actually. I mean, one, it's a transformational technology. And, if you've played with ChatGPT, you realize that the research, capabilities of something like this and the knowledge base that's stored in artificial intelligence, computing power, the types of things that we're seeing in that regard are transformational and will continue to be. The data center question, the amount of infrastructure investment is actually propping up gross domestic product or economic output in the United States quite noticeably. Jason Furman, whom you know at Harvard and formerly the Obama administration and the Biden administration, pointed out that in the first half of the year, infrastructure investment for artificial intelligence, which includes data centers and electricity and software production, accounted for about 99% or so of economic growth. And without it, the economy would have been considerably slower. And still, as we move into the second half of the year, consumer spending among the wealthiest staying quite strong. And the investment in this infrastructure is also continuing to have a positive impact on GDP, kind of almost single-handedly supporting the economy, given the hundreds of billions of dollars being invested in this technology. With respect to the circularity or this kind of what we used to call vendor financing during the internet boom, or I think to a certain extent, and I referenced this in my Substack a couple of weeks ago, the Japanese keiretsu of the 1980s, where one company owned a piece of another company, owned a piece of another company, owned a piece of another company. And so as long as all the companies were doing well, the stock prices went up, and they were kind of interlinked or interlocking directorships. In this case, it's interlocking financing. So as long as these companies are doing well and generating a lot of cash, they're buying and financing each other's products. Now, that is kind of a daisy chain that if something goes wrong, if they don't become as profitable as they need to be to support this, it will unwind violently. We haven't gotten to that point yet, but that's the way this kind of circular flow often resolves itself. But we have to see whether or not AI lives up to its full potential. But we're talking about over the course of the next several years, potentially, $1 or $2 trillion being invested, even by a single company. So where they get the money from, whether it's debt or whether it's cash flow, makes a huge difference. A lot of this stuff starts to get financed by debt and debt only. There's the real risk that the unwind could be pretty nasty, and then it proves itself to be, at least in part, a bubble that's going to burst in the financial markets.
Well, so that is the question I have is, and I think you and I have talked about this before, is the whole concept of number go up. Everything is fine so long as the number goes up. The
100%.
problem is, even in the greatest of scenarios, the number doesn't go up forever.
Correct. And my colleague David Faber, who I brought this up during the height of the internet bubble, there's this notion of terminal value. At what point do the stock prices reflect all the future profits that these companies are going to make? And at that juncture, the stock shouldn't be able to go any higher and should only be able to go lower, because they've already discounted or anticipated all the future profits that they're going to accumulate from their activities. And so I think that's a relevant question now, particularly if they're financing a lot of their growth with debt. Do they lose the ability to service that debt? Do they run into problems with it? And then does that drive the stock price of many of the so-called AI hyperscalers, the big companies that are building out the infrastructure, down dramatically? I think where I'm more currently concerned about problems is in the private credit arena, where a lot of, we're starting to see, not a lot, but enough sloppy lending that has taken place to companies that didn't deserve to get credit from a wide variety of firms. And we've seen a couple of blowups already in subprime auto and auto parts and commercial real estate in Southern California. That's something also to keep an eye on. It's not just what we think is an AI bubble, but a bubble in private credit, where a lot of these firms have raised as much as $1.7 trillion, and they may have lent it out to less than creditworthy borrowers. And so to a certain extent, there's an echo, smaller, but there's an echo of 2007, 2008. Not everybody's levered to this. Not every big bank is overextended the way they were during the housing crisis and the credit crisis of 17 years ago. But there's an element of that that's taking place in the credit markets that people need to be aware of and pay attention to, because that's something that also could adversely affect financial markets down the road.
So I want to talk about I want to get to one other thing, but I want to talk about this whole concept of private credit. So let's make it old fashioned. Go to the bank. I got $100,000 house. They're going to give me a mortgage and a 7% interest rate, right? Yeah. Pretty cut and dry, pretty simple. It's through a bank, chartered entity, insured for this and that. This is what they do. So give us the sense of what, if any, protections or guardrails there are around private credit.
Oh, yeah, none.
Okay. I knew that was the answer. It was a leading question, but I needed to hear you say it.
So what's happened is, banks have been constrained because of the great financial crisis, right? Banks were constrained from doing too many things for a period of time, and their credit standards had to be tightened. The amount of capital they needed to retain in order to meet the requirements of the Federal Reserve and other regulators was higher than it would have otherwise normally been, or certainly higher than it was pre-great financial crisis, when they just went nuts lending on any house that, at any price that ultimately came back to bite them. So as banks were constrained, a lot of these big financial firms raised money for private credit funds. And so they were acting as what they call non-bank financial institutions, or NBFIs. And they were able to make loans to companies, some of which were investment grade, high quality companies that had very secure assets that could be used for collateral. And others, as we're finding out now, were less than investment grade, either had poor collateral, poor prospects, or in some cases out west, actually their customers engaged in outright fraud and borrowed the same amounts of money from multiple different banks, which is something you can't do, because you can't have one bank be on the hook for the same amount of money as another bank and then say that they're both first lien or in the first position to get the money back, right? That's basically bank fraud. And we saw that happen over the last couple of weeks, and that was within the regional banking community. But the private credit companies themselves have been able to lend out now $1.7 trillion across the economy. And we'll see, in the next downturn, or the minute the Fed has to in the future raise interest rates, you could get a washout in that space. And that creates the type of problem, maybe certainly not as large as what we saw in 2008, but a similar type of problem where you get a collapse in the availability of credit. You see either these large financial companies take big hits, or banks have also extended credit to the private credit companies to get around the constraints on their lending. So there could be a little bit of a kind of a daisy chain operation going on here that we probably need to keep a fairly close eye on. I know it's kind of in the weeds, the way I described it, but banks are lending to private credit companies. And so you have two different firms, both the banks and the private credit companies, on the hook for the same collateral.
But, well, that's not good, as you noted.
No.
But also, it seems to me, Ron, that as recently as, say, Silicon Valley Bank, when people who should know better make bad bets, for some reason it's you and me and Joe taxpayer that have to take care of the mess.
Yep, all the time. I mean, look, this has been going on for as long as I've been doing this, and longer. You can go back and find episodes of speculative excesses in first century Rome, right? I mean, you can go way, way back.
Tulips
Yeah, tulips actually turned out, upon further reflection, to be maybe a little less calamitous as was claimed. But still, you saw wild speculation, people selling their houses and buying a single tulip bulb in Holland in the 1630s. Right. More recently, as my colleague Andrew Sorkin wrote about 1929, you saw a lot of speculation among individual investors in stocks. Right. And we've seen bubbles, all throughout our history. But yeah, I mean, at the end of the day, in this environment, if there has to be a bailout that's done through the Federal Reserve or through the government, through the use of taxpayer-funded assistance, we kind of get left holding at least a good portion of the bag. And that's been a feature of modern bailouts, including potentially one having to do with Argentina that's going on right now.
Right, and I'll get to that in a second. But all right, one last question I have on AI and all of these big financial institutions. So I saw a headline that said that both Blackstone and BlackRock are going out and buying up utilities and electric companies. And there was just a story out of, I believe, Minnesota, that one of the Blackstone, BlackRock, whichever, had just acquired that in the assumption that, these data centers will need electricity. There will be, obviously it's ratepayers. But how again, I want to bring it back to the individual Americans. How, now that you've got these massive behemoth, untouchable financial companies owning real assets that have tangible effects on real humans' everyday lives, how do we know that they're not going, when a data center needs an extra 100 kilowatts, that they're going to charge the data center operator a proportion that makes sense as opposed to the individual ratepayer?
Yeah, we don't. And you may have seen this already. Generally speaking, I do pay attention to my power bill because given the volatility in the climate of New Jersey, you're running the air conditioner for 3 or 4 months in the summertime because it gets humid and hot. And then you're running the heater, for 3 or 4 months during the winter, and your bills seasonally go up and down, right? So we had a bill about a month or two ago, and I was looking at it, I was talking to my wife, I was like, that's higher than we normally get. And we are seeing electricity bills already, prior to any of these acquisitions taking place, go up because the demand for power is so huge. It's being pulled away to these data centers. It was crypto mining for a little while, but less so than the power that's required, the so-called compute power that artificial intelligence companies need from these data centers, these enormous, bigger than football field size of operations that require traditional power. They're going to need nuclear power. Rather, ironically and oddly, we're cutting back on alternative power at a time when we need more gigawatts or kilowatts or whatever. But this is having a broad impact on electricity bills across the country. They're already up on average 10% year over year. In some places, it's more than that. Whether or not a private company that takes over an electricity or power generating company starts gouging consumers to offset the increase that they're having to produce remains to be seen. We're in the early stages of that, but power bills have already gone up pretty dramatically anyway, so we probably should expect more of the same.
Well, and again, to me, this is where again, everything we've discussed is many things, but it is not free and open markets, right? It is unregulated markets in my mind, maybe
100%.
And so again, data center A, sucks down a gigawatt a day. Everybody else across the street is doing the best. They get a 10, 12%, jolt. Yep. That's a lot for them, right? It goes from 100 to 112 or 200 to 220, whatever the case might be. Yeah. The data center, it's going to be a percentage on a percentage, whatever they're paying anyway, and they're probably paying off with investment dollars. But that's where you would think, and this is why I don't even know why a public utility would be allowed to be sold to a Blackstone or a BlackRock, right?
Well, right now it doesn't matter. I mean, look, anything can be sold at this point, as we well know, and anything can be funded, including the erection of a very large ballroom just outside the White House, and it's being privately funded, and God knows who's funding the underneath portion of that, which has very secure rooms that for the president to operate in should there be any kind of catastrophe in Washington, D.C. Look, this deregulatory environment, this is something I truly hate. I'm not a regulation freak. Like, I'm not thinking that, everything on the planet should be regulated. Although with respect to now gambling and weed, I'm having second thoughts about both those things. But look, every time we've deregulated and then there's been an abundance of borrowed money used in the financial markets, we have had a crisis. So my guess is that we're 12 to 18 months away from some sort of financial event, if not sooner, that comes from everybody turning a blind eye to not just bad practices, poor practices, but in some cases, even the types of environments that allow people to do virtually anything with money, from an investment perspective or even, mergers and acquisitions and things like that. I think we're in one of those periods that, in my mind, when you combine deregulation with excess leverage or borrowed money, you set the stage for a crisis, and I think that's what we're going through. And I would agree with you. Why let them do it? Well, this environment, this administration is wildly in favor of deregulation from almost every corner of the marketplace, including, as we well know, crypto and other areas from which certain people now derive a fair amount of their net worth.
Right. Well, all right. So let's move well south of the equator to Argentina, a country I have visited many moons ago and loved it. I thought it was a beautiful place. People were nice. It was a great experience. We are now going to send them. Now, Ron, tell me exactly what it is. Is it 40 billion in federal funds?
Not
is it
yet.
40 billion in investment? Like, what's going on and why, aside from the fact that Trump likes the guy's hair?
Yeah. If only we had it.
Right.
And by the way, he's a phenomenal rock singer. I might point out as well, President Milei's concert was truly an impressive feat. No, right now it's a $20 billion currency swap, as it's called. So we're propping up the Argentine peso. We're selling $20 billion and then buying $20 billion worth of pesos to prop up their currency. It's not fully in effect at the moment. We've spent some of that money already in an effort to prop up their currency. It hasn't been terribly effective. And the administration is going to U.S. banks and asking them for an additional $20 billion in lending capabilities to lend to Argentina. The banks are somewhat chary about this, as you might imagine, because they've been down this road in Latin America before, where they lend tens of billions of dollars and the collateral's not there, or the discipline around their spending and habits from a governmental perspective is not there, and they end up eating the $20 billion, and you get some minor banking crisis because yet, and I don't mean this to sound totally disparaging, but yet another Latin American country defaults on its debt. Argentina has done this now on a routine basis for over 100 years. And so while it's a beautiful country to visit, my maternal grandmother was born there, they have been less than responsible, generally speaking, over time. They still owe the International Monetary Fund tens of billions of dollars that is yet to be repaid. They've never been, at least in my lifetime, a good economic bet. Milei has cut the deficit. He has brought down the inflation rate. He has engaged in what we call in economic terms shock therapy to kind of try to right size the Argentine budget. But he's faltering a bit. The unemployment rate there is up to nearly 8%, and he's having trouble getting the rest of his reforms through. So this could just be good money after bad. And part of it, it's not really a taxpayer issue at the moment. It's really more money that's available to the federal government that isn't financed by you and me. But it could be a bad bet where the U.S. ends up just losing its $20 billion, throwing good money after bad.
And again, is this simply because Trump has a personal relationship with him? Because Scott Bessent likes Buenos Aires? Is there something, is there something else at play?
Well, he's got some friends who are on the hook for some bad bond investments. They made a lot of money off Argentine bonds, some of his hedge fund friends, and then took it on the chin this year. This is really a political bailout. It's not an economic bailout. This is to keep Milei in power because he lost regional elections not too long ago. They're coming up on midterm parliamentary elections that threaten the viability of his government. And so it appears that President Trump is trying to prop him up. And it's suggested that some of that money wouldn't be available unless his party won and kept him in power. So, that's not like what we did with Mexico in 1994 and 95, where we lent them money. They were having a currency crisis. They ended up paying us back with interest, and actually their economy improved after we intervened. This is a different, horse of a different color, if you will. Yeah. And I think that with respect to Secretary Bessent, I found it rather ironic, and I mentioned this to Stephanie Ruhle on MSNBC the other night. He said that we're really trying to defend the Argentine peso against speculators. Well, Scott Bessent was with George Soros and Stan Druckenmiller when they broke the Bank of England in 1992 and drove the value of the British pound down and knocked it out of what was then Europe's exchange rate mechanism. It was the grid where all the European currencies traded. And they decided the British pound was overvalued. So they shorted it, made $1 billion in a day when the pound broke through. And so it's kind of ironic that Scott Bessent himself, once a speculator, would turn his ire towards those who would dare to short the Argentine peso, which was a much weaker currency than even the British pound was back in 1992.
Right. And you also mentioned the boogeyman, George Soros, in that sentence, right?
Yes. Yeah. Well, he worked for George, right? And Stan Druckenmiller, who I've known well, and I knew George back in the day. Look, they also did this again in Asia in 1997. They were short the Thai baht, the currency of Thailand, and they were short all these other Asian currencies because they were overvalued. They all broke, and you had the Asian currency crisis in 1997. I don't know if Bessent was still there at the time, but that's what speculators do. They see things that are overvalued, they sell them short, and if things go their way, they make a lot of money.
Yeah, but there's a lot of damage in the aftermath.
There can be, certainly, yeah. I mean, if you go back to the Asian currency crisis, those economies were wrecked for years and took quite a lot of time to rebuild. But their currencies were overvalued. Their fiscal policies and their monetary policies were really detrimental to their health. And so something had to give. The currencies are usually the things that break first.
Gotcha. All right. Before I let you get out of here, is there anything else that you're taking a look at that you think that the listeners and viewers of the Home Front should be paying attention to?
Yeah, look, I think there's just this toxic, and we've talked about this before, this toxic brew of policies coming from this administration where, as much as economic growth surprisingly remains relatively robust in the U.S. for two reasons, one of which we spoke about, which is AI investment is propping up GDP. And the top 10% of American wage earners, according to Mark Zandi at Moody's, account for 49.2% of all consumer spending. They too are propping up the economy, while the middle and lower, quartiles, not quartiles, lower income brackets are either keeping up with inflation or falling behind. And on top of that, this is all being exacerbated now by the government shutdown, now the second longest in history. This policy set, which includes tariffs, which have no real fundamental economic rationale, deregulation, the shutdown itself, the possibility that Affordable Care Act subsidies will go away and that 22 million Americans will see those prices go up by double or more. It's the type of thing that's just going to shock the economy. This is no golden age. We're not doing better today than we were 2 years ago. And I think people are somewhat complacent to a certain extent about this combination of policies that is, directly impacting their lives. Now, having said that, I was watching some shows this morning, and the president's underwater on the economy by anywhere from 13 to 19% in the polls, whether it was CNBC or whether it was Quinnipiac. The polling on the economy is not good, and grocery prices are up. And it's funny, my wife said to me about a week or so ago, she was, I was shopping, I brought home one bag, no meat, $75.
Right.
I haven't had that conversation since the 1970s, when my parents, and then there was this, great article a couple weeks ago, or a week and a half ago, about the fact that these recession indicators have started to tick higher. Hamburger helper sales increasing, right? If you might not be old enough to remember this, but in the 1970s, when your parents started buying hamburger helper,
right,
they were trying to stretch their grocery dollars, right?
Right, sure.
Purchases of cardboard, linerboard, and other types of cardboard are falling because package deliveries are coming down. The big truck sales, and I'm talking about delivery truck sales, are down. These are indicators of impending economic weakness. And you also have inflation that's still stuck. So I'm staying with my mini stagflation story here, that it's not 1980 where unemployment's 11%, inflation's 13%, and interest rates are 20%. In fact, quite the opposite. The Fed's going to cut next week by another quarter point. But inflation's sticky. Growth is holding up, but the labor market is weakening. It's a very odd combination of things to see, and it's unsatisfactory for everybody but those who have money. So it's a very strange place for the economy to be, because at some juncture, people are, if you'll pardon me, people are going to get pissed, and they're going to start changing their attitudes about where we are at the moment.
Consider me pissed. So, all right. Ron, before I let you go, first and foremost, thanks for joining me. Where can everybody find you online? Where can they find your writing and anything else?
So my writing now is on Substack, The Message of the Markets. That's out there, and I write as frequently as possible. I try to go in depth on the weekend with a segment called What I'm Watching So You Don't Have to, and kind of just bring people up to date on things they might have missed that would be otherwise important on Instagram, on Facebook, on Twitter, X, whatever you want to call it, on LinkedIn, of course. So it's got my name attached to it. It's somewhere in social media, even Threads. I show up there. So yeah, pretty much wherever I can. And a lot of time on MSNBC with my good friends, Stephanie Ruhle, Katie Tour, Ana Cabrera, that whole crowd.
Perfect. As always, gang, you can find me on Twitter, TikTok, X, says.us, at Reed Galen, on Threads and Instagram, at Reed_Galen USA. Ron Insana, thanks for joining me.
Good to talk to you, man. Thanks.
Everybody else, we'll see you next time. All right. Cool.